Are you planning to buy a house or saving up for one? In this video, we will discuss determining the affordable housing based on your salary. I will provide 3 examples of salary ranges: $40,000 per year, $80,000 per year, and $150,000 per year. Housing affordability has been affected by the significant increase in mortgage rates in recent years. Mortgage rates were as low as 2.65% in early 2021, but have now risen to the range of 6.5% to 7%. This means that having a mortgage payment these days is much more expensive compared to a year or 2 to 3 years ago for the same home. Additionally, the rise in unaffordable housing is coupled with an increase in homelessness across the U.S. In this video, we will cover both renting and buying a home, focusing on affordability. We will discuss these topics with the 3 salary ranges mentioned earlier. When it comes to renting, there is a personal finance rule stating that your rent should not exceed more than 30% of your gross income. For example, if you earn $40,000 per year, your gross income is $3,333 per month. Multiplying that by 30% gives you an approximate rent affordability of $1,000 per month. With an $80,000 salary, you can afford $2,000 per month in rent. And with a $150,000 salary, you should be able to afford around $3,750 per month. However, there are some problems with the 30% rule. Firstly, it doesn't consider other debts like credit card debt, auto loan debt, or student loan debt. If you earn $50,000 per year, for instance, your gross income is $4,166 per month after taxes. According to the 30% rule, you should spend about $930 on rent, leaving you with $2,170 for the rest of the month. But if you have additional debts amounting to $500 per month, your available pay after rent decreases quickly. Another issue is that the median rent price is $1,942 per month, while the median income in the United States ranges from $50,000 to $60,000 per year, or approximately $4,166 to $5,000 per month. This shows a significant gap between what people can afford and what they earn. Following the 30% rule can be beneficial for your overall financial situation and increase your chances of buying a home. Avoiding credit card debt and other debts will also be advantageous. We will now discuss the topic of housing affordability for buying a house for the remainder of this video. When it comes to buying a house, there are 2 personal financial rules: the 28 and 36 rule and the 30-33 rule. The first rule, the 28 and 36 rule, focuses on the payment you qualify for in the eyes of the lender, while the second rule, the 30-33 rule, provides a guideline for what you can afford. The 28-36 rule states that your monthly mortgage payment should not exceed 28% of your monthly gross income to qualify for a mortgage. For example, if you earn $80,000 per year, your gross salary is $6,666 per month, and multiplying that by 28% gives you a mortgage payment of $1,866 per month. With a $40,000 annual salary, the payment decreases to $933 per month, and with a $150,000 salary, it increases to $3,500 per month. The N36 part of the rule refers to your total monthly mortgage payment plus all your debts, such as credit card debt, student loan debt, and auto loan debt. This combined payment should be less than 36% of your monthly gross income to likely be approved for a mortgage. However, it's important to note that being approved for a mortgage doesn't necessarily mean you can afford it. Approval simply indicates that you are likely to make the payments and not default. The bank doesn't consider your existing savings or 401k in this assessment. They are primarily concerned with your ability to make the monthly payment. Now let's talk about the 30-33 rule and how it can help you determine how much house you can afford. The basic idea is to keep all your housing payments, mortgage, interest, property taxes, and insurance under 30% of your take-home income. If you can stick to this, you'll be in a great position to save and invest for the future. Now, I know this rule may not work for everyone, especially in high-cost areas, but it's a good starting point to understand your financial situation. For example, if you make $40,000 a year, you can afford around $1,000 per month for housing. If you make $150,000 a year, you could go up to $3,750 per month. It's important to find a balance that works for you. Maybe you can stretch your housing budget a bit if you're in a pricey city, but be sure to track your spending carefully. And remember, what works for one person may not work for another, so focus on your own situation. If you're struggling to save for a down payment, consider the 30% rule for cash reserves. Having 30% of the home's purchase price in cash can help cover unexpected costs and avoid private mortgage insurance. It may be a challenge to save up that much, especially with rising rents and inflation, but it's a good goal to aim for. Consider keeping your cash in a high-yield savings account while you save for a down payment. There are plenty of options available with competitive interest rates. SoFi Alley, Wealthfront, and Marcus by Goldman Sachs are just a few examples. So if you're thinking about saving up for a down payment on a house and it seems like it's going to take a while, you might want to consider investing your cash in the market. Just keep in mind that there's always a risk involved with investing, as the market can go down as well as up. It's a decision you'll need to make based on your comfort level and financial goals. With mortgage rates hanging around 6 out of 7% this year, making a larger down payment can really help lower your monthly payments. The general rule of thumb is not to buy a house that costs more than 3 times your annual income. For example, if you make $100,000 a year, you could potentially afford a home up to $300,000 in value. However, in high-cost areas like New York or San Francisco, following this rule can be a challenge due to the soaring home prices. In San Francisco, where the average home price is over $1 million, following the 3x income rule can be nearly impossible for many residents. Most people in their 30s are making between $100,000 and $150,000 per year, which falls far below the income needed to afford a home based on this rule. Across the U.S., the median home price is around $416,100 as of the second quarter of 2023, which would require an income of at least $138,700 to follow the 3x rule. Combining incomes with a spouse may be the only realistic way for many people to fit into this affordability range. Adhering to the 30-33 rule, where you save 30% of your home's purchase price in cash and keep your monthly housing costs below 33% of your income, is a great financial achievement. However, with rapidly rising housing prices, meeting these criteria can be a challenge for many. Ultimately, affording a home or rent depends on your individual circumstances, income, savings, and location. It's important to consider all these factors when deciding how much house you can afford. I hope this information has given you some insight into the housing market and helps you make informed decisions about your future home. If you'd like to boost your income with dividends, do check out my other video on how to earn dividend income from a 10K investment in the link above or in the description down below. Do you own a house or saving up to buy one? Comment below. If you enjoyed this video, do like and share this video so that more people will learn about how much housing they can actually afford. Check out this playlist of my top 10 videos for creating wealth, and I'll see you in the next video. Take care.